All right, let's get right into it. If you're a Singaporean investor and you've been thinking about jumping into the US market, this is for you. We're going to break down everything, the huge opportunities, yeah, but also the hidden risks you really need to know about and how to get ready for them. Okay, first things first, let's talk about sheer size. The US market is, well, it's a giant. We're talking $50 trillion. It absolutely dwarfs our Singapore exchange. I mean, to put that into perspective, you could have a single US tech company that's worth more than our entire local market. That's the kind of scale we're dealing with here. And this is why everyone's attention is on the US. Look at these numbers. Between 2009 and 2021, the S&P 500 gave investors an incredible 430% total return. 430%! Now, compare that to Singapore's STI. Still a respectable 62%, but you see the difference, right? That massive gap in growth potential, that's the real siren call for investors. Okay, so you're sold on the potential. How do you actually get a piece of the action? Well, it's probably easier than you think. Let's walk through the first practical steps to get your US account up and running. It's basically a simple three-step dance. First, you pick a broker that's regulated by MAS, a trusted one. Second, you upload your usual docs, NRC, proof of address, the standard stuff. But that third step, completing the US tax form, that one is non-negotiable. It's absolutely crucial for anyone investing from outside the US. And that form has a name, the W-8BN. You're going to see this everywhere. All it is, really, is you telling the US tax authority, the IRS, hey, I'm not a US citizen, I'm a foreign investor. It's basically your passport into the US market. You have to get this done, and done right, so your broker handles your taxes correctly from day one. All right, let's talk money. Not your investments, but the cost of making those investments. You see all those ads for super low commission fees, right? Well, that's not even close to the whole story. Now, don't get me wrong, the competition between brokers in Singapore is fantastic for us. It's driven those headline commission fees way down. I mean, you can see trades for less than a US dollar. That's amazing. But, and this is a big but, that's just the tip of the iceberg. This is where you have to be a detective and read the fine print. Because beyond that main fee, you've got things like currency conversion spreads when you change your Sing dollars to US dollars. There are tiny US regulatory fees on your sell orders. Some stocks have what's called an ADR custody fee. And on top of all the service fees, you've got our own 9% GST. They seem small, right? But these little things, they can quietly nibble away at your profits if you're not careful. Okay, this next section is maybe the most important part of this whole conversation. Seriously, we've talked about fees, but the US tax rules for foreigners, they've got a couple of major expensive surprises. Let's call them the two dragons you need to slay. The first dragon, the first number you need to tattoo on your brain is 30%. 30. That's the automatic tax the US government takes from every single dividend that a US company pays out to a foreign investor. Like you. And here's the thing. Because Singapore doesn't have a specific tax treaty with the US covering this, that 30% is set in stone. There's no getting around it. It's simple math. A US company pays you $100 in dividends, you only get 70. The other 30 is gone before it even hits your account. So that 30% dividend tax stings for sure. But here's the crazy part. That's not even the scariest dragon in the cave. There's a much bigger, much more hidden tax that catches so many people completely by surprise, usually when it's way too late. Let me introduce you to the US estate tax. This is a tax on your US assets after you pass away. And for non-US residents, that's us, the tax rate can hit a staggering 40%. And get this, the amount that's exempt, the part they don't tax, is only 60,000 US dollars. Just 60,000. Okay, let's make this real. Imagine you've done everything right. You invested for years, you were smart about it, and you built up a really nice US stock portfolio. Let's say it's worth $1 million. Congratulations. But wait, here comes the tax man. Out of your $1 million, the US government only lets you shield the first $60,000. That's it. So the remaining $940,000 of your money, it's sitting there completely exposed to that estate tax. So what does that exposure mean in cold hard cash? Well, with a tax rate up to 40%, your estate, meaning your family, could get hit with a tax bill for over $370,000. I mean, think about that. A huge chunk of the wealth you built is just gone, wiped out by a tax you probably never even heard of. Okay, that sounds terrifying, I know, but don't panic. Now that we know what the dragons are, we can figure out how to get around them. So let's talk about investing smarter to protect your money. So one of the biggest strategic shifts you can make is to focus on growth stocks instead of high dividend stocks. And here's why. The really good news for us is that neither the US nor Singapore taxes your capital gains. That's the profit you make when you sell your shares for more than you bought them. So that's completely tax-free. Compare that to a dividend stock where you're automatically losing 30% off the top. The choice becomes pretty clear from a tax perspective. Now, to deal with that big, scary estate tax dragon, you've got a couple of really smart options. First, look for ETFs, exchange-traded funds, that are based outside the US. A popular choice is Ireland. These ETFs can own all the big US stocks you want, but because the fund itself isn't American, you can potentially sidestep that US estate tax. Genius, right? Or, the simplest strategy of all, just make sure the value of the US stocks you own directly stays under that $60,000 limit. If you stay below the threshold, the tax doesn't apply. Simple as that. Okay, so let's bring this all home. What's the final verdict? Investing in the US can be an amazing engine for growth, no doubt. But it's all about balancing those massive rewards against some very real, very specific risks. Let's put it all on the table. So on the plus side, you get access to the biggest, most dynamic market in the world, and you get to keep all of your capital gains tax-free. That's huge. But on the other side of the coin, you've got that automatic 30% hit on dividends, that monster estate tax risk lurking in the background, and you're always exposed to the ups and downs of the currency exchange rate. The potential is absolutely incredible, but you've got to go in with a plan. Look, at the end of the day, the US market is a world of opportunity, but it's a different game with a very different rule book. The key is that now you know the rules. You know about the hidden costs, you know about the tax dragons, and you know the strategies to navigate around them. You can now invest with your eyes wide open. So the global market is right there for you. The only real question left is, what's your move going to be?